It's starting. The first bank failure of 2026 has officially happened. But the question on everyone's mind, is this an isolated event or a canary in the coal mine? What does this tell us about the banking system as a whole? And most importantly, what does this mean for your deposits and your financial future? In case you missed it, Chicago's Metropolitan Capital Bank and Trust was shut down this weekend. Regulators stepping in to pull the plug, citing unsafe and unsound conditions with an impaired capital position, aka they were broke. Now, the FDIC, the Federal Deposit Insurance Corporation, stepped in to oversee the failure, honoring deposits up to $250,000.
To understand how this happens, it helps to understand how banks actually work. Banks do not simply store money in vaults. They take deposits and use that money to make loans and investments. Those loans might go to businesses, real estate projects, or consumers. The investments might include bonds and other financial assets. As long as borrowers keep paying and asset values remain stable, the bank earns income. That income pays expenses, covers risks, and creates profit. Problems begin when loans start to fail or when asset values drop sharply. If borrowers miss payments or default, the bank loses expected cash flow. If investments lose value, the bank's balance sheet weakens. At first, these losses may look manageable. Banks often assume conditions will improve. They may delay recognizing losses or try to earn their way out of trouble. But if losses continue, capital shrinks. Capital is the cushion that protects a bank from failure. When that cushion gets too thin, even small shocks become dangerous. At some point, the bank may struggle to meet daily obligations. It may rely more heavily on short-term borrowing. It may face pressure from depositors moving money elsewhere. Regulators watch for these warning signs. If a bank cannot restore stability, regulators step in to prevent wider damage. That is what happened here. This event matters not just because one bank failed, but because it is the first such failure in the United States in 2026. The first failure in any year often sets the tone for what follows.
It's a big misconception that you actually own the money that you have in the bank, when the truth is the bank owns your money, and that means your money can be used to bail them out. A bail-in is when a failing bank uses depositors' funds, that's your money inside the bank, and the debt that's owed to creditors to save themselves and keep going. Whereas bailouts help prevent creditors from taking on those losses, bail-ins mandate creditors take the losses.